There are two important questions small business owners often ask us. Is it worth it for me to incorporate? And if I do, how should I pay myself? One of the biggest considerations in this matter is how it will affect the taxes you'll have to pay. For starters, the biggest distinction between how a corporation and a sole proprietorship are taxed is that the sole proprietorship is taxed fully in the owner's hands, whereas the corporation pays its taxes directly. Often the corporation's taxes are taxed at a much lower rate, provided they meet the $500,000 income threshold for small business. In simpler terms, if your business makes enough money that you're left with a significant amount of funds in your account at the end of the year, and you'd rather reinvest those funds in the business, a corporation is right for you. On the other hand, if you earn a more modest income and more or less spend what you earn through the year, sole proprietorship is the right decision. This leads to the second part of the common question. How do I take my income from my corporation? First, you want to make sure that you've exhausted your shareholder loan account. This is the shareholders' after-tax funds that they've already invested in the corporation, and as such can withdraw those funds without incurring any further taxes. The two main options for withdrawing taxable income from a corporation is salary and dividend. The key advantage of the dividend is that since it's a distribution of the corporation's profits, it's taxed at a much lower rate. Some disadvantages, however, are that if the dividends paid through the year, the shareholder is on the hook for a large tax bill at the end of the year. Also, dividend income doesn't generate RSP contribution room. To generate that RSP contribution room, you need earned income, and drawing a salary does just that. As well, your personal income tax is withdrawn through the year and remitted by the corporation, so that saves you the worry of having to come up with your tax bill at the end of the year. As well, salary drawn is an expense of the business, helping to maintain the $500,000 income threshold. So clearly, the question of how you should structure your business and how you should pay yourself is not a one-size-fits-all answer. Contact us today, and we can consult with you to help determine the right course of action.